Welcome, and thank you for joining us for the Nest Edge. This is where we bring you the latest and greatest economic and market updates. We named the Nest Edge. Also welcome to everyone who's joining again. And I think I already said that, but
so selfish, Gloria.
Anyway,
all about Gloria.
So we named this the Nest Edge because we have a unique way of looking at data that gives us an edge over the choppiness of news cycles. Please note that this webinar is for educational purposes only and not for investment advice. We like to educate our clients and our audience about how we do things, how we see things, and what we see coming. For those of you who are interested in learning more about how to work with us and apply data-driven methods to your own portfolio, please feel free to send us a message at info@nestfinancial.net. If you have questions throughout the webinar, please feel free to throw them in the chat box. We do not provide investment recommendations, but if you are seeking advice, we'll be more than happy to set up a one-on-one. So with me, I have Sean McDougall, our portfolio manager at Nest Financial. And we're going to get started on taking a deeper dive into the recent newsletter that was released. And so there were two main topics that were addressed. There were a few other things, but two main topics that were addressed, which is this new COVID variant that's kind of spooked the markets, and also the Fed admitting to inflation being a problem after many months.
Yeah. The old transitory thing couldn't work anymore.
Yeah, that line wasn't flying anymore. And because of these two things, the markets were a bit spooked and a lot of volatility started to erupt in November and beginning of December. So, Sean, tell us what the data is saying. Like, what are we hearing from all this?
If you haven't read the little blog thing I did, read that. That'll kind of better summarize it, but I'll do a quick version. We had expected inflation to eventually cool off. And as this often does happen, sometimes those expectations get pulled forward. If the markets sniff it out faster than the data will, markets, the signal will front run data. So sometimes, often, when you go through these regime changes, like we've been on this train with growth and inflation accelerating, just call it, to be lazy or closely accurate, a year and a half. And the markets are trying to figure out what's next. And it started to sniff out the inflation cooling thing. And that's caused a shock because now the Fed has finally woken up to what has been going on for over a year. And now they're worried about inflation. It is probable, and we are anticipating it's actually going to start cooling here. We're seeing it broadly across all commodities. We're starting to see it in the bond market, the currency market, things. It's starting to cross over into multiple markets. So it's not just as centralized as if it was just equities acting goofy like they do, I wouldn't be as concerned. But the thing that kind of spiked this thing, it's hilarious. It's like external forces. That's what makes this game so wild sometimes. Is the Omicron variant. Kind of spooked the commodity space because there was that lazy narrative like, there's only two things that can either be super great or super bad. Like things are super great now, but now we have Omicron. So now we're going to go all the way back to, spring 2020 with a complete lockdown. So commodities got absolutely smoked when that variant came out. The news of it, and more importantly, not just the news of the variant, but the travel restrictions were coming back on. So everyone's running around with their hair on fire, screaming, crying over something we don't have enough information on. Now, since then, it seems like, and I use the word seems like because we still don't know, but on lab testing, we need some more real world data. But from the lab perspective, the Omicron is going to be a more contagious, less intense or deadly version of the first strand of COVID-19 and even Delta. And as I was talking about in that little blog, I think, I don't know anything, especially in this avenue of information. It could be a net positive if it's more contagious more people get it, but the symptoms are less, and you're less likely to go to the hospital and God forbid die. We can speed up and quickly get to that herd immunity that we're so desperately trying to get to. But for whatever reason, I'm not going to go down that rabbit hole right now. So Omicron spiked the commodity fears. And so the thing that made it interesting to us, not that there's this new variant, which is interesting, but they've been occurring all along. I heard of Omicron in like October. Like, it's been around for a minute, and it's probably already here in the States and has been here for a minute. But what it caused was a ton of volatility to pick up in the commodity space. And that commodity hasn't cooled off. If anything, it's still there. So that changes our outlook. It just pulls forward those expectations that inflation is going to cool. My trading range on a barrel of oil, on copper, on natural gas, on wheat, everything that we actively pay attention to is making a series of lower lows and lower highs of like probabilities of where it's going to trade going forward. The vol is just, it ripped and it's staying up, so that just everything is being rolled forward by a month or so. And that's not abnormal. It's pretty, when we're going through a regime change, that's kind of what happens. That's, it's uncomfortable. It's painful when you're shifting gears, going from, we've been in what's called quad 2, oscillating a little bit into quad 3, but largely quad 2, into sliding into what we view as quad 1, which is slowing inflation, rising growth. There are certain things that work really well in quad 2 and 3 and suck in quad 1, and vice versa. So whenever you can get head fakes when you're shifting in between, or you think you may be shifting in between quads. But we need to see the sustained data, and that's kind of where we are now, kind of, because we're still very early on. When the markets are shifting or pricing things in, it's never one point in time, like tops and bottoms. It's never like this, perfect little point in time. It's like, oh, that's when you should have bought or sold. It's a process. It's going to take time. It took time for us to kind of shift the models. There was like 2 or 3 weeks I was very busy. We were rolling in like 7 positions and rolling out 7 positions, and I was doing it across 5 different models. I've never done that many in at one time, and we're still some tweaks to do. We're just waiting for the ideal time. There's still a lot of noisy news out there, and I'm rambling. What are we, 7 minutes in? I think you've said 3 things so far. I could.
Yep.
So by and large, the only thing that we still have to unwind, we still have a little bit of energy exposure with XLE. Mm-hmm. In quad 1 that we're going into, and that just talking historically, everything goes up in quad 1, pretty much. It's just some things go up more than others. So we're going to try to take advantage of that. It is still possible that we could have a quad 4 on the horizon in Q2 of 22. Quad 4 is the exact opposite. Everything sucks outside of like treasuries and gold. That is the thing that we have on our horizon. We don't know, how deep we go into these quads matters significantly. So that is something that is on our horizon. But the major shifts that have happened in the last month have been, we've been positioning, instead of rising growth and inflation, we know inflation is starting to cool, or it's probable it's going to start to cool. The next wave is growth that's going to start to kind of cool. And when you think about it from a macro perspective, that makes sense. Things never go in a straight line forever. I don't care what it is. Things never go up forever. Things never go down forever. And we've been on a run with growth since the spring, since the world economy shut down. It has been on a tear just because things were so bad. We were comparing against us just all sitting at home. Well, now we're going to have to compare against those numbers. So that makes sense. Year over year, the data is going to appear to slow. Same thing with inflation. Inflation's been on an absolute tear. CPI numbers that came out recently was 6.8. That's insane to say that out loud when like the Fed's mandate is to try to keep inflation around 2. Mm-hmm. So we've more than
the Fed met yesterday and they're meeting today, and there's a flutter of some news that they're going to
perfect day to talk about. Yeah,
raise
they're going
rates.
to double. They're going to double what they're saying today, and I'm seeing blips of it. I have not died. I was watching a little bit of earlier. They're going to double the rate of their tapering and it is on the radar to do a rate hike in 22. That is what they're saying as of now. We'll see. These guys are, again, we roll back 3 months, they were talking about, inflation being transitory, and now inflation is the boogeyman. So I don't rely on these guys to make the best decisions. They're generally, they're playing defense and responding late.
So they're planning to pull stimulus or pull money out of the market, financial support, but also increasing rates. So this could possibly be reflected in, I know that there's been a craze this year about people refinancing their homes and buying homes, and possibly next year rates aren't going to be as great.
Possibly. The wild card to that is if treasury yields fall off a cliff, then mortgages are actually going to be cheaper. So it's not as simple. Everyone thinks the Fed is this, they can bend economic reality and fix every single problem. Now, them pumping trillions of dollars in there absolutely helps, but their effect on rates is not as big as they like to feel that it is. The bond market controls what rates really do, in my opinion. Mm-hmm. I mean, whatever. The bond market is the smart. And I've said this a billion times. You've heard me say this. The bond market is really, you can learn so much more about what's coming down the pipe, what's getting priced in, and what's trading in the bond market, not even, domestically, but overseas, than you can in equities. If you're trying to get a bearing of where we are economically, looking at U.S. domestic equity markets, we're the Looney Tune kid running around in the playground with his hair on fire. We get so spooked so easy. It's calm down, everybody. I mean, it's just so antsy. And that's just the way we are. That's just the way the domestic U.S. markets, that's the way they always have been. We're the largest and there's the most active players. But when Omicron stories were coming out of South Africa and Israel, I don't know, let's call it 3 weeks ago. I can't remember exactly when. I was watching those equity markets and they were calm. And they were the ones that were having the cases. And the U.S. is losing their mind, oh my God, we're shutting down again. In South Africa, the doctors are it doesn't seem like it's going to be that big of a deal. But U.S. equities is just a bunch of nervous Nancy's.
It's a lot of fear. I think so much. I think the U.S. market, equity markets have really taken advantage of that fear of another March 2020 happening again, and, possibly using it for their advantage. And of course, financial media doesn't help in pumping all of these things about the variant, which is we know very little about still.
And what we know is it should be fine. I mean, from what we know, it's been largely in a lab testing. We need more real world testing to be sure. But I mean, sitting here with what I'm seeing, December 15th, right? Yeah. I think it's gonna be fine.
So Sean, with this new outlook of inflation starting to slow down, that's a pretty big shift from before where, we had the outlook of inflation accelerating. So with this new outlook, what positions, are we moving out of? I know you mentioned energy, and what are we moving into?
The big major difference is we're almost completely out of commodities. I think we still have coffee in there. Yeah, we still have coffee. And, if we roll back 2 months ago, we had a ton of things in there. So we're out of commodities outside of coffee. Our foreign exposure is completely different. We recently were long Norway, Russia, Saudi Arabia. I think those are the three that we were long that were tied in with the barrel of oil. We're completely out of those. We still have a little energy exposure via the ETF XLE. The difference, out of the commodities, out of energy. We're not completely out of energy yet. There's still some components of it that we want to. The new things that we're going to be getting into is consumer discretionary, housing, technology. Our foreign exposure really is Israel. Economically, they're set up wonderfully. Israel and Canada are probably our two overseas exposures that we've been adding lately. But from an economic perspective, in the short run, we still should have some positive forward momentum. Again, things are a process. I think we are topping from a growth standpoint. I think that 6.8 CPI number that came out recently is going to be the high watermark. Probably there may be another one in that same neighborhood, and it's going to start rolling. Just pay attention to PPI numbers going forward. CPI numbers get front run by PPI. So if PPIs, which they have started to cool, if you pay attention to those numbers, it's like pay attention to commodities. PPI is like input costs for manufacturing. So it's just another way. If you're waiting to see to get the data from those CPI numbers from Old Wall or Congress, then it's already priced in. It's already done. So paying attention to PPI and commodity prices will give you a heads up of which way it. And you don't know to what level things are going to go to. Like say, hey, all right, it's at 6.8. Where is it going to go? Like, I don't lower. You don't need to like pinpoint numbers or make these calls. Just which direction is it going, and specifically the rate of change. The rock, is it fasting? Is it slowing? Like those are things that as long as you're on the right side of it, you're going to take a ton of risk off the table.
Yeah, direction and speed.
Yeah.
Okay.
Me telling you the numbers stupid. I don't know.
Hey, numbers are great. We love numbers.
Well, a level. I'm sorry. It's like, all right, we're gonna go from 6.8 to 3.7.
Yeah.
It's dumb. Like no one knows. But I guess that's why I'm not going to be on the CNBC, because that's what they want and demand is to make calls.
Yep. They want those predictions.
Headlines. Yeah.
Yep. And so with all the volatility that we've seen in November and December, how are the portfolios doing? I know we have our moderate, which is that middle of the way portfolio, and we have our most aggressive one, alpha. What's going on there?
I mean, year to date, we're still blasting our goals. I have not looked. I know last week we had a good week. The week before it was a bad week. It's just because it's going to be choppiness for a while. I think so far the month of December, everybody's up 1% or 2%, depending on where you are on the scale of things. November, we got whacked. That's when we really started seeing all of that commodity prices get pulled in. And that's what we were sitting in. We had started to fade out of them towards the end of October because largely I was just booking gains. I was like, all right, this is getting so frothy. We just, the Omicron variant news hyperdrived that expectation of inflation cooling. It just got sucked up about 6 to 8 weeks sooner than anyone anticipated, or at least we did, or our research partners. So that was November was real big about, on when things were up, the things that we were trying to get out, I was selling like crazy, those things. And then the things that we were trying to get into, consumer discretionary, tech, housing, that's when I was buying things on red. Because it's been a pretty boring year, to be honest. That's what I kind of talked about in the webinar. It's just been like, we had the same outlook. And it was just kind of like trading around core positions. And then things got real. We started seeing some ripples in September, but really in November is when it was like hot. Here we go. Have to do a little work this month. But December is going to be a little. December's been not as intense as November, but still pretty choppy waters. And that's just kind of what we're going to see until all of these new expectations gets priced in. Don't let the volatility freak you out. I know on paper it sucks, but it's part of the deal, man. Like whenever we're shifting gears and you're seeing an actual change in regimes, which is what we're going through, it's part of the deal. There's going to be at major turns, there's going to be blood, and that's just you just can't let that stuff panic you. It's you can't have the upside without some downside, and we're going through some shifts right now, and we're gonna get through this. We're gonna be on the other side of this, and I'm not concerned whatsoever because we knew at some point this was coming.
Oh yeah, I mean it can't be great forever, right?
Just everything. Commodities couldn't keep going up straight up to the right forever, which is what made our year.
And I think it's great that even though we've had this volatility, all the portfolios have exceeded their targets, which is great.
Everybody's hitting their goals. I'd like to get all of them back up to the all-time highs where we were in October, and that's the goal. Try to, I know a lot of people care a lot about year-end numbers, and I understand why, but that's not the way of the game. It really matters. It's not like the markets care that it's the end of December and they're going to book things in or not. But it's, the game doesn't stop on January 1st. It's just an ongoing, it does not change, what I will or will not do. I just, whatever the numbers say, that's where I go. Right now we're setting up.
The train keeps going. Just don't get hit by it.
Oh yeah. Yeah. That would hurt. Yeah.
All right. Well, I'm going to open it up to our audience to see if there are any questions. If there are, please post them in the chat box. And looks like we don't have any questions right now. No
questions. I just explained things too well this time.
You're just so good, Sean. So good.
Says no one. I over-explained. Like I got into a vague argument with this buddy of a buddy last night. And I could tell he was glazing over because I was just getting too deep in the weeds. That's probably why I don't get as many questions as I should, is because I just ramble.
Well, we can end this one early today. And if anybody has any questions, feel free to send us an email, give us a call, and we would love to chat with you. Once again, this Nest Edge webinar is not investment advice. We provide these for educational purposes only. If you do want some one-on-one time and want a review of your portfolio, please feel free to reach out. Also, after this webinar, you will receive a recording of the replay. So feel free to send that out to anyone you think who is wanting to learn more about portfolio management, market updates, and how they can improve their finances. So, well, I guess this is it for us.
Done early. Wow.
Yes. Have a wonderful Christmas and happy holidays and happy New Year's. And we'll see you next year. Take care.
Adios.